For the first time in, 4 decades, the undisputed leader, Asian Paints, is at a massive strategic crossroads. Now, its fundamentals are still stable, but make no mistake, they are being tested like never before. The story we're really digging into here is a classic showdown: entrenched dominance versus some very aggressive, very well-funded disruption.
So, to really get why this challenge is such a big deal, you first have to appreciate the sheer strength of the fortress Asian Paints has built over the last 40 years. Let's start with the bull case, the foundation of why they've been so successful for so long.
And this, right here, gets to the absolute heart of that fortress. Its distribution power is just unrivaled. For years, the entire bull case for this company rested on this incredible, seemingly impenetrable supply chain moat. Just think about it, servicing over 150,000 dealers, often multiple times a day. This network wasn't just a set of trucks and warehouses, it was their kingdom.
But of course, that was then. And that fortress, which everyone thought was untouchable, is now facing a serious, coordinated assault. And that brings us to the bear case, and how the competition finally woke up.
Now, what's really fascinating is who is doing the challenging. These aren't small startups. We're talking about giants with incredibly deep pockets, conglomerates like Grasim with their Birla Opus brand and JSW Paints. And their strategy? It's laser-focused. They're going straight for the jugular, attacking Asian Paint's greatest strength, that dealer network, by offering them better margins and sweeter terms. They're trying to buy the loyalty that took decades to build.
And here's the immediate result of that attack. You can't avoid it. This chart shows a massive spike in what's called below the line, or BTL, spending. To put it simply, Asian Paints is being forced to pour crores into dealer incentives and promotions, not to grow the business, but just to defend their turf and stop their network from jumping ship.
Okay, so this battle for the dealers isn't just a strategic headache. It has a very real and very painful impact on the bottom line. Let's look at the actual financial damage this new competitive heat is causing.
Now, the most crucial thing to see here is that this is not just a bad quarter or a cyclical dip. This is a structural reset. For years, Asian Paints comfortably enjoyed 20% operating margins. That's now eroding to a new normal of around 15 to 16%. And it's a direct result of those higher dealer payouts, on top of volatility in raw materials like crude and TiO2, that's titanium dioxide, by the way, a key ingredient. The latest numbers from Q3 FY26 basically confirmed it, with a 150 basis point drop in EBITDA.
And of course, the stock market, which always tries to look ahead, is reacting fast. For years, investors were more than happy to pay a huge premium for this stock, a PE ratio of 60, even 70 times earnings. Well, as you can see, that premium is fading. With earnings growth slowing down into the single digits, the old story of growth at any price for Asian Paints is pretty much over.
So if you're a 40-year-old titan and your famous moat is finally being breached, what do? Well, management has launched a two-pronged counterattack. One part is defending the core, and the other is diversifying to find new ways to grow.
Okay, the first part of their plan is a big strategic pivot. They're trying to shift from being just a paint company to becoming a complete home decor provider. The ambition is pretty clear: get 15% of their revenue from businesses that aren't paint, things like bath fittings and kitchens. The whole idea is to get a bigger slice of the customer's wallet long before they even start thinking about what color to put on the walls.
The second part of the plan is a high-tech defense of their core business. They're doubling down on something they call Project Renaissance, which is an AI-driven system for forecasting demand. This is all about sharpening their oldest and best weapon, logistics. The goal is to squeeze every last bit of efficiency out of their supply chain and really push for volume-led growth, even if it's in a world with lower margins.
So you've got the 4-decade fortress on one side and these new, deep-pocketed disruptors on the other. All of this brings us to the final verdict on the new reality for Asian Paints.
And the verdict, for now, is watch and wait. Look, Asian Paints is right in the middle of a tough transition, shifting from a high-growth superstar to a more stable, mature company that's facing some serious headwinds. For a long-term portfolio, the consensus is to hold, but the real key is to wait for clear signs that these new, lower margins have finally found their floor and stabilized.
And this really leaves us with a big question for the future, doesn't it? Has the entry of these new giants permanently lowered the profit ceiling for the entire industry? Or can Asian Paints' two-part strategy of diversification and tech-driven efficiency actually help it reclaim its old dominance? That is the multi-crore rupee question the market is waiting to see answered.